Welcome to Intelligent Investor Insights with Joshua Barone and Robert Barone, your co-hosts and guides through the noise of today's markets. Here we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
Deep inside the Treasury ledgers, the United States government officially values its entire physical gold reserve, all 261,496,926 troy ounces of it, at exactly $42.22 per ounce. That statutory price has been completely frozen by federal law since 1973.
$42.22. Dad, spot gold in the real market is hovering right around $4,100 an ounce. So on paper, Fort Knox, Denver, and West Point are carried at what? $11.04 billion?
Exactly $11.04 billion on the Treasury balance sheet, while the actual physical market value is well over $1 trillion. Now, under Title 31, Sections 5116 to 5117 of the United States Code, Treasury does not have to sell a single physical ounce of bullion in order to unlock that massive market gap. Congress could simply pass a short, one-line statutory price update overnight.
Walk us through the inner workings. If Congress changes that statutory number from 4222 up to market price, what actually happens step by step between the Treasury and the Fed?
The mechanics are straightforward. The Treasury revalues the gold on its balance sheet. To monetize that mark-to-market gain, Treasury issues new gold certificates to the Federal Reserve in that exact amount. Under federal law, the Fed is required to accept these gold certificates and immediately credit equivalent liquidity directly into the Treasury general account. Boom, roughly $1 trillion of brand new spendable cash sitting right in the government cash account. No Treasury bond auction, no tax increase, just poof, $1 trillion created on a ledger.
The ultimate monetary accounting hack. I actually remember sitting at the dinner table back in high school when you first explained FDR doing this kind of balance sheet trick in the 1930s. You practically slammed your fork down, explaining that typing extra zeros on a central bank computer does not generate a single dime of real productive wealth.
Because it does not, Josh. Revaluation is a pure balance sheet illusion. It generates spendable central bank reserves out of thin air to cover up structural budget deficits without creating one single dollar of actual goods, services, or productivity in the broader economy.
It masks the structural rot. But when you have a government spending at record levels and carrying exploding interest costs, a free $1 trillion sitting behind an old accounting quirk looks like the ultimate escape hatch for Washington. Let us examine the history, because governments have used this move when backed into a corner.
Indeed, they have. Look at January 1934. Franklin Roosevelt signed the Gold Reserve Act, seizing gold and revaluing official holdings from $20.67 to $35 per ounce. That was a 69% overnight price increase.
69% in a single day. And what did that paper adjustment yield for the Treasury back in 34?
It yielded a $2.8 billion accounting windfall. To give context on how massive that was, $2.8 billion was equal to over 40% of the total federal budget of $6.5 billion in fiscal year 1934. Roosevelt used $2 billion of that gain to capitalize the Exchange Stabilization Fund and finance federal relief projects without having to issue new debt to a capital-starved market.
Equal to 40% of the national budget created with a pen stroke. Then fast forward to Richard Nixon in the early 1970s.
Precisely. Nixon severed dollar convertibility in August 1971. That was followed by the Smithsonian Agreement in December 1971, raising official gold to $38, and the Par Value Modification Act of 1973, which set it at $42.22 per ounce. When the Bretton Woods fixed rate system completely collapsed into floating exchange rates, Congress simply left that statutory price untouched. It became a dormant accounting relic for over 50 years.
So it stayed frozen on the books. But this is not just an American story. Other central banks across the globe have tried tapping paper gold revaluations to patch up fiscal holes or deal with currency stress.
They have, and the empirical evidence is very clear. Federal Reserve economist Colin R. Weiss published a landmark research paper analyzing 5 major international gold revaluation episodes: Germany, Italy, Lebanon, Curacao, and Sint Maarten, and South Africa. The paper highlights that while revaluation adjusts balance sheet values, it adds zero real physical reserves or economic momentum.
Let us look at Lebanon in 2002 as a case study. What happened when they tried this?
Lebanon used its revaluation paper gains to cancel $1.8 billion of outstanding treasury bills, which represented roughly 11% of their entire gross domestic product at the time. On the balance sheet, public debt metrics improved overnight, but because the government failed to address its underlying fiscal spending deficits, those gains were quickly wiped out. Within a few years, debt levels surged to new highs, ultimately culminating in a total economic collapse.
It acts as monetary anesthesia. It dulls the immediate pain, but leaves the underlying structural disease completely untreated.
Exactly. Look at the domestic picture today. The United States national debt is barreling past $40 trillion, with annual interest costs exceeding $1 trillion alone. Dropping $1 trillion gold revaluation cash balance into the Treasury General account gives politicians fresh cash to spend, but it does not retire one single dollar of national debt.
Not a single Treasury bond is canceled or paid off. The outstanding gross debt remains 39 to 40 trillion, and the compounding interest burden continues to accumulate every single second.
And here is where the macroeconomic transmission mechanism becomes critical, Josh. When the Treasury drains that $1 trillion out of its account by paying for government programs, contracts, and transfer payments, those funds enter the private commercial banking system as new bank reserves and broad money deposits,
which expands liquidity without any market clearing bond issuance. Institutional investors and foreign central banks will recognize that as fiscal dominance, where monetary operations are direct tools to finance government deficits.
That is the core risk. When global bond markets realize that spending is being fueled by paper gold adjustments rather than fiscal discipline or genuine growth, inflation expectations reaccelerate. Bond yield curves steepen, term premia rise, and international confidence in the sovereign credit of the United States weakens.
Let us dig deeper into the actual statutory language and legal mechanics behind Title 31. Under Section 5116, the Secretary of the Treasury is authorized to buy and sell gold. But Section 5117 explicitly governs gold certificates. When the Treasury revalues its gold stock, it issues these non-transferable certificates directly to the Federal Reserve banks. The law mandates that the Fed must issue credit to the Treasury General account equal to the valuation. There is no discretionary veto by the Federal Open Market Committee or the Fed chair.
So the Fed is legally bound to execute the ledger transfer that bypasses traditional central bank independence entirely. In traditional quantitative easing, the Fed decides to purchase treasuries on the open market to manage monetary policy. Here, the Treasury unilaterally forces an expansion of central bank reserve credits onto the Fed balance sheet.
Exactly. It is direct monetization under an administrative legal loophole. Now, consider the international historical precedents detailed in Colin Weiss's research. Look at Germany in the late 1990s, prior to the formation of the Eurozone. The Bundesbank faced pressure to revalue its gold reserves to meet the Maastricht Treaty debt and deficit criteria. The central bank fiercely resisted because revaluation created paper profits that distorted public fiscal metrics without altering real productive economic output.
And look at Italy during the same era. They utilized accounting maneuvers to meet European Monetary Union convergence criteria. While it allowed them to pass immediate statutory benchmarks, it did nothing to fix structural economic growth, leading to decades of stagnant productivity and high debt to GDP ratios. The fundamental economic truth remains constant across decades and borders. You cannot inflate or account away structural deficits.
Look at South Africa in the late 1990s as well. They enacted statutory changes to revalue gold balances to adjust central bank liabilities. While it cleared immediate central bank balance sheet friction, it provided zero net benefit to the broader economy, foreign exchange reserves, or real wage growth. The paper gain is strictly an internal accounting journal entry.
Let us trace what happens when that $1 trillion hits commercial bank balance sheets in detail. When Treasury spends cash out of the Treasury General account, say to pay federal contractors or fund entitlement checks, those checks are deposited into commercial banks like JP Morgan, Bank of America, or regional banks. Commercial bank reserves at the Fed increase dollar for dollar, expanding the monetary base.
And that increase in bank reserves occurs without any corresponding extraction of capital from private markets, which is what normally happens when Treasury issues debt bonds. Normally, when Treasury sells $1 trillion in bonds, private capital buys those bonds, draining liquidity from private markets into government hands. Gold revaluation bypasses that crowding out mechanism, sending a wave of unbacked liquidity directly into financial channels.
That unbacked liquidity wave is precisely why bond markets react violently to fiscal dominance. When Treasury bond investors see liquidity expanding without debt auctions or tax collections, they demand higher yields to compensate for future inflation and currency debasement. 10-year and 30-year Treasury yields rise, driving up mortgage rates, corporate borrowing costs, and municipal financing costs across the entire real economy.
It becomes a self-defeating exercise. Any short-term fiscal relief gained by Treasury through gold revaluation is rapidly offset by soaring borrowing costs on the remaining $39 trillion of national debt. A 50 basis point rise in average interest rates across $40 trillion in sovereign debt adds $200 billion in annual interest expense every single year. The accounting trick burns down the house to warm the living room.
Which brings us back to disciplined portfolio management and risk management for investors. When sovereign balance sheets resort to monetary engineering and balance sheet gimmicks, real assets, capital discipline, and cash flow fundamentalism become essential. Investors must focus on companies with pricing power, sound balance sheets, and real cash generation that do not rely on monetary illusions.
Sound money, productive capital, and fiscal discipline are the enduring pillars of financial stability. Everything else is just paper balance sheet games designed to delay the inevitable reckoning.
In short, you cannot accounting trick your way into financial stability. If Washington eventually reaches into the vault for this 1973 accounting lever, it might buy a few quarters of fiscal room, but at the cost of long-term currency credibility and bond market stability.
That gives our listeners a complete deep dive into the legal, historical, and macroeconomic mechanics of gold revaluation. Great breakdown, Dad.
Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional level analysis, and a partner in building durable wealth. Reach out to start the conversation with a member of our team, Robert, Joshua, Andrea, Mike, or Eugene, and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.